Thank you for including my silliness. Hi, everyone. In the words of Monty Python, now for something completely different. Uh, what the hell are we doing? So, companies must report their financial status via 10K reports, amongst other things. Yes, I'm going to teach you some accounting today. I'm sorry. Companies want to look good. They want their earnings to go up so that more people buy their shares, so the stock price goes up, and so that they make more money. Many of us are interested in money here because we live in a society that monies. Uh, and regulators want to watch companies that do bad things, that like lie in order to get more money, because like that's illegal and bad. Uh, and I did an MBA recently, and this sounded like a fun machine learning problem. And it was a fun exercise in how to adapt adversarial machine learning to something that it has not really been applied to at all. But it's very interesting. It has lots of fun parallels to our field, I think. Um, and obviously, according to my wonderful picture here, if this is being recorded, if you are someone who works at something like the Security and Exchanges Commission, this is totally not for profit. This is education. Please be chill. Don't arrest me. They're on furlough. Yes, excellent. Humor. Okay, so let's talk about our threat model. Um, Here's this wonderful, beautiful picture because I am an artist. You have companies that have to produce financial reports, and they go to the SEC and they go into a database that is visible to the world. The companies control the reports. The companies write the reports. And so these reports are how the world is judging you financially and if you deserve the monies that the world has. And so you can alter your financial reports in order to make yourself look better. There's things called like earnings management is like finance speak for like, hey, we're going to sort of fudge this in a legal, kosher, acceptable way. And then you can push that too far and become fraud and get arrested. But so these financial reports get put in this database, and investors, hedge funds, you'll go to Yahoo Finance and like get things like the PE ratio, and you'll say things like, "Man, Tesla's PE ratio is crazy. Should I buy more Tesla? What do they know?" Um, audience participation is good. Um, and so they'll compute things from those ratios to decide, should I invest in this? At the same time, regulators will also use these ratios to compute things and decide like, hey, does it look like funny business is going on here? Should I go like regulate or investigate or do something? And if you can successfully increase your earnings per share while reducing your fraud score, you can get better rates on your bonds, you can get more revenue, or you can raise more money per share that you sell to the market, and less regulatory oversight, so that you can have more fun on your yachts and whatever you're doing. So we're very interested in this. Everyone's interested in this now. I've got everyone on board. So let's talk about what does this actually mean to do this, and why is this interesting? Um, Let me back up. Why this is really interesting from a machine learning perspective is the regulators and the investors have two very highly correlated things they're measuring: your profitability or your risk of fraud. If you look super profitable, you also kind of look super fraudy. They kind of go hand in hand. But your objective is to make these things go in opposite directions, which actually makes this very technically difficult and fun. So before we get to the fun, let's talk about other things that make this problem technically interesting. And so to me, this has parallels to cybersecurity, and there are constraints to your world. You can't just arbitrarily change a feature vector and say, oh, it's adversarial. Like that has to be able to exist in the world. It needs to be a problem space attack. Or, hey, like there's these systems that are interconnected and you can't just change one without changing the other. This happens in finance. So if you don't know, there's a thing called the balance sheet and income statement and cash flow statement. And these are some of the primary basic things that go into these reports. And if you're a good accountant and you follow generally accepted accounting principles or GAAP, there are rules about how you report these things. And so these are some of the things that get reported and their acronyms, because I'm not going to spell these out every single time, but they interact with each other in interesting ways. So like total assets, like what do you own? How valuable are you? And you have your like net liability somewhere, like, okay, like how much do you owe other people? And if your net liabilities is greater than your net assets, that doesn't look good. Um, and all these things interact with each other in interesting ways. I will talk about a few of these in detail. If you want to like quiz me on how much did I learn in my MBA afterwards on individual ones, I'm happy to go through the quiz. Um, so here's where things start to interact with each other in interesting ways. Some of these things are interdependent. You can't just change one without necessarily changing the other. So LT is your total liabilities. Um, LCT is your short-term liabilities, DLTT is your long-term liabilities. These add together to be your total liability. So if you change your long-term liabilities, you also have to change your total liabilities. You can't change one without changing the other. Dashed lines here are things that subtract from their parent. So DP is depreciation. Your net income minus your depreciation change is your total net income, right? So all these things are adding or subtracting together to produce your net income. Rev'd is your revenue, you have your sales and your operating expenses. So all these things interact with each other in cool ways. And so if I want to perturb these variables to produce an attack that produces something good, I need to make sure I respect all the constraints of how these variables interact with each other under GAAP accounting principles. So, okay, that's cool, fun, and interesting. And then we have the ways that people use these variables and create more complex equations out of them. Like accountants have been doing feature engineering for 50 years and they don't know it. Which is great. And they're like, oh, okay, like, oh, we're machine learning people. We were smart. It's like, actually, the accountants have been doing this. So what can we learn from them? What can they learn from us? Or as this title talk could have been called, How to Scare Your Accountant Friends. Anyway, so these are a number of variables used in a fraud model. And they're called accounting ratios. Not all of them are actually technically ratios, but they call them all ratios because, I don't know, they do. And so you'll have things like day sales and receivable index, where you're looking at, in this case, ratios over 2 periods of time. So T minus 1 means the previous year. If there's no sub-index, that means it's the current year. So you're looking at your ratio of your accounts receivable divided by your total amount of sales, and that's a useful metric, and you're looking at that change on a year-over-year basis to say, like, okay, did you have an abnormally large spike in this ratio? And like, okay, that's kind of funny now. Why did that go up so much? And there's similar logic to all of these different variables. We don't need to dive into the particulars of these variables unless you really want me to, but okay, we've got now cool feature engineering happening here too, and you can see that some variables occur in multiple equations. So day sales and receivables index uses sales and uses the revenue. Gross margin also uses sales and it uses cost of goods sold. Sales also shows up in sales growth index. So now you've got, if you alter one feature, you're altering all these different feature and engineered features on top of your base features. So you now have to respect this on top of the GAAP rules as well. So now this is cool and complex. We've got lots of interactions here that we need to respect in our code. And then we need a way to model perturbing these things. And so we're going to have T different years of history. So I've got my historical data from this company because my variables use current and previous years. And we're going to have our matrix of data X that's going to be the values, and we're going to have this perturbation matrix P. And our matrix is a perturbation matrix that goes along with this sparse matrix M that is encoding the constraints of when I modify depreciation, I also have to modify net income. So my M matrix encodes these constraints on the relationships between the base variables. And then my code that implements the attacks Well, every engineered feature is actually just going to be a differentiable function, so that when I am performing the attacks, I'm recomputing all features from scratch every time, and I can then differentiate through all those engineered features to make sure that I'm respecting the reuse and interaction of those variables in the features. And so we're going to have some optimization goal, minimize or alter my perturbation matrix P in order to satisfy this objective. And I'm going to have some epsilon that says like, okay, keep this perturbation within some reasonable range. There's literature showing that the amount people will fudge a number by in order to commit fraud can be like 70% or higher. So I test up to 40% because I want to make sure my fraud is realistic. Okay, let's continue. So what are my objectives? I've got three objective functions we want to explore because it's a multi-objective. It was in the title. You had to know there was going to be more than one objective. M-score is one of my objectives. This is like the most famous fraud model from 1990 something. I forget what year. It's really old. It's still in use. There was a school project that got put online looking at Enron with the M-score, and they're like, Enron kind of looks like fraud. And then it was. So like this actually is used. It's actually like kind of works. Finance people are super cagey. Like hedge funds will not tell you what they're doing like day to day, but these are things that are published in the literature and have been used by regulators and used in the literature to show like, hey, this actually can find things. S-score is similar to M-score. It's newer. It's like only 2010 or something, or 2013. And that's a second fraud score. So we can test like, hey, can I modify two fraud scores at once? And then our anti-correlated objective, right? So we want to reduce M-score. We want to reduce the S-score because those are fraud scores. We want to both increase our earnings per share, our final objective, while reducing our fraud scores. So we get more money and look better because that's how we roll. I think I had it on my slides here that's been used for 26 years. It's hard for me because like the text is behind my head and I don't have eyes behind my head. I apologize. So again, all three of these objectives move together naturally. They're highly correlated with each other. So getting them to go in opposite directions is what makes this fun and interesting. So how do we do that? This is where the maximum violated multi-objective attack comes in. If you take one of these objectives, calculate a gradient, you're going to move them all in a similar direction because they're all so highly correlated with each other and they're all using the same features. And the feature space is not that big. And as we were just looking at, the objectives we're trying to tackle are all linear. So you don't have the same kind of like nooks and crannies that you have in a large overparameterized neural network to sort of hide weird things in the margins of the space. And so what's also challenging about this is we're doing a regression problem, not a classification problem. Regression problems end up being weird and complicated because now you have different objectives on different orders of magnitude as well. And so like earnings per share, if we go back a slide, has one ratio in it. And so you can more easily move this by large orders of magnitude sometimes. And this creates like a super incentive for the optimizer to just keep pounding on that one objective because it can move that objective by an order of magnitude more easily than any other objective. And it just hyper focuses on it. So you have to fight this varying magnitude issue at the same time as there's sort of natural correlation. So what we do is we do our attack based on a relative log change. So that's where I have this sine dt minus d0 times the log of that plus 1. So what we're looking for is the order of magnitude directional change from the starting point. So if I've improved earnings per share by 10 orders of magnitude, and I've only improved the other objectives by 1 order of magnitude, I need to focus on these other objectives because I need everything to shift by sort of like relatively equal orders of magnitude to feel like I've actually made a meaningful improvement. Not to feel like it, to have actually made a meaningful improvement. Because what will happen is you'll have the attack objective go in the wrong direction. But again, if EPS is so easy to optimize sometimes that it'll just keep driving it because that'll overwhelm the objective. So we have these, and then we're taking a softmax over these in order to have the optimization dynamically, as you go at every step, focus on the most violated objective. So again, if I've got earnings per share I've successfully increased, but my fraud score is also increased, I need that doesn't satisfy the goals. I need the fraud score to come down. I'm going to stop optimizing earnings per share until the fraud scores come down. And if everything is making equal progress, then it degrades gracefully back to standard projected gradient descent. Not quite standard. I've got this order of magnitude thing, but it'll gracefully become projected gradient descent and treat everything equally. And as they become unbalanced, more and more optimization effort is spent on the most violated objective. So we can handle multiple objectives simultaneously. It will focus on the most violated objective. So we get the name because we're computer scientists. We name things in a very literal, dumb, simplistic sense because that is our nature as people or as computer scientists. People at large are better. Okay, let's keep going. I've got a few more minutes. I've mentioned what M is earlier at a high level. It encodes these constraints. Let's talk about the constraints and the ways that you can commit fraud. These are real strategies for committing fraud. My co-authors include 2 CPAs and a lawyer. This is legit. We're here for realsies. Cost of goods sold. You can reduce that for $1 and increase your general and administrative expenses by $1 or your staff expenses. These 3 things all look very similar from an accounting perspective, and it's often very hard to decide where does $1 go between these. So no one's going to bat an eye if you shift one from one place to the other. Don't do this. Current liabilities and long-term debt. Current liabilities are basically debts that are due within the current year. Long-term debts are due more than a year from now. You can shift them back and forth. So I want to reduce my long-term liabilities. I'll just pay it off now and say it was a short-term liability. What do you care? It's paid off. You got your money. Well, I want to shift current liability to long-term debt. I can just say, like, oh yeah, that's due next year. Well, how are they going to know? Again, don't do this. Accounts receivable and revenue, sales. So the way life works, if I sell Hiram $10 million of computers, and he gets to put $10 million in accounts receivable, but he hasn't actually received the money yet. But that still goes into your sales. So it looks like you've got $10 million of sales. So I can just say, or Hiram can just say, yeah, Edward sold me $10 million of computers. I didn't actually do it, but he can just say it. And he can record it on his accounting sheet. And then next year, yeah, the deal fell through. I got to remove it. Sorry. How's anyone going to know? Again, don't do this. Equipment and occupancy expenses and property, plant, and equipment basically deal with the distinctions on having and owning property and running the property itself. Again, what's your factory worth? And how much does it cost to maintain your factory? Like, you could fudge these around. How's anyone going to know? It's a property. It's a physical asset. Like, it's hard to really know the exact value of this asset. So you can fudge things around here as well. Depreciation. This is another really common one for fraud. So you have an asset. You've got a phone. This is a $10 million phone, and I would just say, like, yeah, I'm depreciating $1 million of this. I bought 10 phones. I didn't actually. I'm depreciating each of them for $1 million. How do you know? You can just say it. You can put it on your accounting spreadsheet. How are they going to track it? These are all real fraud strategies that are used in real life to commit fraud. So that's what goes into the M matrix, and then you can commit fraud. Congrats. So here's our results of committing fraud. It's kind of hard to see with the projector. So the bottom region is this green region of failure to increase earnings per share. So most of the probability mass is not in that region because we're successfully increasing earnings per share. Good and bad. About half the time, we can't successfully produce an attack that satisfies both higher fraud or higher earnings per share and lower fraud scores. So like, good job accountants, you engineered by hand some pretty robust features. Because like if I said I could have 50% success defending ImageNet, you'd be like, wow, that's damn good, right? So like, okay, that's pretty good. On the other hand, in the 50% of time where I can succeed here, I can reduce fraud score by increasing earnings per share up to 200%. So the failure cases are still pretty big. And this is very interesting. And then we can also add the S score to this as well and say like, okay, can I satisfy 3 objectives at the same time? And the answer is yes, it takes a little more effort. You lose a little bit of effectiveness, but you can satisfy multiple objectives, not just 2, you can satisfy 3. If you could find a third one or a third fraud score to add or more, you could just keep adding and see eventually when does it stop working. But generally it does work. So yeah, who wants to ask me questions about why I still have a job?
Have you examined existing balance sheets to look for signs of these techniques? Is that a valid way to trade stocks?
Um, I don't know that it's a valid way to trade stocks. Maybe there's some like hedge fund person here in the room who's like, "Ooh, I'm going to try this now." I haven't looked at uh, balance sheets to see if someone's trying something like, because you can't really know easily from the other side what they're doing here. And this attack is constrained to be within the realm of what you could plausibly like get away with, or at least like smaller than what people have gotten caught doing. Uh, but these are actually real strategies for how people do commit fraud. And normally this is like a manual process done by someone with like a spreadsheet who's trying to do fraud. Uh, to me, what's interesting here is understanding the tools that are being used and how much robustness they actually have without having known about this plausibility of performing automated attacks like this. And where I would want to go in the future is how can I use this to design more robust ratios and models that sort of minimize the scope of how big a success can be. Was that helpful?
Thanks for the talk. Very interesting. Most of the techniques that you showed seem like they would work at the kind of high level financial report, but if someone actually dug in at the line level, they could realize something was going on. For example, if you write off $1 million for your phone and I'm just looking at a whole report, I won't notice that. But if I go down to the line level and actually look at the details of that, that would stand out.
Well,
So do you, just to wrap up, do you see opportunity in like models that go down to that more granular level, or does that technology exist?
so people don't get the more granular level. When you go look at a 10K, you get only these ratios or these variables that I had here at the beginning. This is what you get in a 10K. There's no lower level for you as an investor or a regulator to dig into. Now, this does get into why am I publishing this and talking about it? Is there are other safeguards in place. Primarily, if you're a big company and you're traded on the stock exchange, you are required to have basically one of the big 4 accounting firms audit your reporting every year. So they, as your auditors, will have more granular access. But there's also stories like Arthur Andersen that does not exist anymore. And there is a principal agent incentive problem with them as well. So it's not foolproof, but there are other safeguards in place.
Yeah, I'm wondering if we could automate that, we could do auditing more often, since it's so human intensive right now. That's probably why it's not happening that much.
Why what's not happening as much?
You said auditing is only happening for like select companies of certain sizes, but it could happen more often if we could automate it.
It could happen more often if we automated it. Auditing happens. Most every publicly traded company is like audited regularly. There's a conversation on like how much of like smaller companies exist in the realm of like the fuzziness between fraud and like it's just hard to do accounting and you're not a big company that can afford super professional accountants. But that's like a really in the weeds discussion that I'm probably not the most qualified person to have.
Thank you.
Thank you for your presentation. I have a general question. What can be the significant challenge if you want to design a benchmark framework to assess different type of adversarial attacks in a large scale?
The biggest impediment, so all this data, there's a Wharton School database that's made available to business schools who have lots of money to pay for this database. If you don't have access to that, this is not, I mean, it's all publicly available, but it's in like the world's most adversarially formatted PDF files. So the biggest issue is just getting the data in the first place, really.
Thank you.
Thank you, Edward, for a talk. It's interesting example of application of techniques that we all basically know out of domain. And you kind of hinted in the first answer that you had that you see there is potential for a more robust kind of scoring.
Mhm.
So like substituting M and S. Have you thought about this? What are the potential kind of examples that we can influence from a defensive machine learning to apply here? So
Yeah. So I think part of this, oh, I went too far in the other direction. Part of what I think makes this interesting and is a potentially generalizable insight. So everyone's like, ooh, neural networks. But neural networks are these weird, giant, nonlinear monsters, and they give you lots of nooks and crannies to hide in. But like, Enron was caught by linear regression. And if you're doing linear regression, you have a lot more tools available to you to analyze it and make provable statements and make guarantees about what you're doing and understand the maximum scope of which anyone may sort of dupe you in your model. And we have a lot more sort of sophisticated tools like linear programming solvers that can help us do this with relatively little effort. So I think this is something that could be applied to a lot of other domains. It's like, hey, stop trying to make it deeper. Like, let's claw back a little bit and like, how could we make something simpler equally effective or close to equally effective, and then gain benefits in being able to scope the realm of possibility that our adversaries can do, than just sort of say like, well, it's a big black box and I did adversarial training. What else can you want from me?
Awesome talk. I'm kind of curious. You said earnings per share and the two fraud scores are correlated.
Yes.
Based on your results, clearly there's some region where they're not so correlated anymore that you can exploit. Do you have any insights on like what that is? Like, are there new ratios or something that the M score and S score clearly are missing?
That's what I want to get to if I could find more time or a student who, for whatever reason, is really interested in financial fraud. This was done on a large swath of companies, and lots of companies have very weird different business models. So there's like some of these strategies, like I'm going the wrong way again. modifying property, plant, and equipment versus equipment and occupancy expenses does not work for lots of companies because they just don't have enough of either of those kinds of expenses baseline to then commit fraud with. So like, because my perturbation is a relative percentage, if you've got zero property, plant, and equipment, I can't modify that variable. Or if you're a cash-only business, you have no accounts receivable. You only have sales. This is something where there's a niche area of work called symbolic regression, where you use genetic algorithms to develop larger regression equations that I think would be very useful and interesting to apply here. And you could potentially constrain that genetic search to be within equations that avail themselves to like convex programming solvers so that you can make statements about the resulting equation. But time is limited.